We welcome back one of our favourite regulars, Jason McIntosh from Motion Trader, for a top-down view of how traders are approaching these markets at the moment. Jason, always great to have you in the studio. Look, we've got a lot of event risk on the table this week with the FOMC, a couple of local events, US equity markets on record highs. So how are traders positioning themselves ahead of that event risk?
Yeah, it's really interesting looking at the market, seeing how things are shaping up. It's there are some markets which I'm seeing a couple of the big markets showing some divergence. There's some other markets at key technical levels, and also seeing some interesting correlations in the markets. So what I've done to sort of answer all that is I've put together a chart pack. So I thought we'd look at the S&P 500, the FANG stocks. They're interesting to have a look at the moment. Also the US dollar index and gold. So yeah, some interesting things to talk about, and hopefully offer some good ideas to the viewers.
All right, well, let's start with the S&P then. What are we seeing on the charts? Why is this a good base to start with?
Yeah, well, look, this is a terrific looking chart. It's it's a classic bull market, really. Like from that COVID low for the last about 15 months now, we've seen a steady and consistent rally. There have been pullbacks and consolidations along the way. And it's interesting that all those consolidations and pullbacks have held above the moving averages. So I've got a 50 and 100-day moving average on the chart. And look, I think that's a sign of a really healthy market. When a market rises, it stays above the moving averages and it doesn't race away from it. So that's been one of the things which make this a healthy market, because it hasn't spiked away, raced really hard. It's been consistent. And I think it's fair to say that the uptrend's still well and truly in place. There's no outwardly obvious signs of a top coming into play. And look, as a trend follower, I'm long the market. I'm long the Aussie market. I'm still getting signals to buy stocks. And but look, that said, it's like one of the things I love about the markets is, like, I'm a rules-based trader, but I also like to look across a broad number of markets, and it's like a giant jigsaw puzzle. And it's just so fascinating to put the pieces together and see what picture could be coming up on the horizon. So that's what we're going to do with this next chart. So the next chart is looking at the S&P versus the FANG stocks. Now, the FANG Plus is the index I'm using. The FANG Plus is 10 of the biggest tech stocks. They're the heavyweights like Facebook, Google, Twitter, Tesla. They're all the big names are in there, the ones which have been really driving the market. And really from the lows last year, the FANG stocks actually bottomed a couple of days before the S&P 500. So they've really been a really big driver of this whole move up. But what's been interesting since February is that the S&P 500 has continued to make a series of new 52-week highs. But if you look at the FANG index below, where I've got the blue circles marked on the chart, it's been making lower highs. So that's a divergence which we're seeing develop in these two big markets. And look, divergence is an interesting thing. Some people see divergence and go, oh, okay, that's it, this is a sign of a top. Doesn't always work out that way. Divergence can sometimes just be one market's lagging, then it catches up and the divergence disappears. But it is a warning sign. It's something to be aware of and to pay close attention to, I think. Because like, you think, if the S&P is going to rally from here, I think it really needs participation of those big FANG stocks. The financials and the cyclicals, they've done a great job, taking it higher since February, but to keep going higher, it's hard to see that happening without the FANGs. And when you look at the FANG stocks individually, like there's a whole lot of confusion within that in itself. You've got the Facebooks and the Googles going up, the Amazons and the Apples going sideways, and then you've got stocks like Tesla and Netflix below their 100-day moving average. So I think this is a warning sign to be aware of, and we've just got to see how this plays out. It should be really interesting.
And how does the forecast for the US dollar come into how you're trading and how you're looking at the broader market at the moment? Because of course all of the central banks are in focus. It's a race to the bottom when it comes to their local currencies. Where do you see the US dollar fitting into this story?
Yeah, there's a lot of bearishness around the US dollar, and that's been around for a while. We hear about deficits and spending, modern monetary theory, low interest rates, it's inflation, all these reasons why the dollar should fall. And the dollar has been falling for pretty much the last 12 months. But if we look at this chart here, the dollar's now down at a key technical support level. Now this level goes back to 2009. It's between 90 and 88. So back in 2009 it was a resistance point. Now it's a support. And so we've seen the market come back, test that level in late December, early January. It rebounded, it's come back, but look, the fall it's had over the last couple of months has really lacked a lot of momentum. And I think that these big levels usually don't break quickly and easily. I think it's quite possible that we do see another rebound off this. So it may not be a long-lasting rebound, but a rebound nonetheless, I think is, well, look, that'd be my favourite view from here, and then we see how that rebound looks, and then maybe we have another test of these levels later in the year. But this is, I think this is significant for equity markets in the near term at least, because we've had a good correlation between, an inverse correlation between the dollar and equities over the last year. So if we have a look at this next chart, so what I've done here, I've inverted the dollar index. So basically I've flipped it. So where we can see the dollar index rising on this chart, it's actually falling because it's it's the mirror image. And it's interesting to compare this to the S&P 500, but you can see there's this quite a close correlation when we look at it in this like this. Now the dollar and the S&P don't always correlate. There are times when you get strong dollar, strong currency at the same time, like in the mid to late 90s. But over the last year, they've been very much moving in lockstep. So look at those horizontal lines. So when the dollar index goes sideways or comes back, the S&P 500 tends to go sideways as well. And this makes sense because, the currency's been, a lower currency's been good for US manufacturing. It's helped the economy come along. So if we go through a phase now where we see some dollar strength, look, maybe it takes away one of the tailwinds to the market. So look, the trend's still up in the S&P 500, not calling a top by any stretch, but I think this is important for portfolio positioning in that I don't think now's a time to be really leveraging up, taking on a whole lot of new risk. You've got positions on board at the moment, I'd be letting them run like I do my own. I have my trailing stops if things change. But I'm also selective in where I'd be putting risk on, looking at the stocks I'm taking on board and keeping in mind that the market has come a long way. And we do have a couple of flashing lights that say things could be, we could be going into a consolidative period at some point, maybe over the next couple of months. We're in that seasonally weak part of the year, so it wouldn't be at all surprising to see things, slow down until we get back into the stronger months later in the year.
Yeah, that summer lull is always important in the markets. All right, so where are you trading then? I know gold is another one that you're looking for. It's broken through some key levels recently. Is this a buy for you? Yeah, well, we were talking about this just 4 or 5 weeks ago. We were looking at this gold chart, and it looked like it was starting to gather momentum. It had quite an impulsive move from its lows back around April, and it was looking to break higher, and that's exactly what it's done. It's continued to push higher. And interesting looking at this chart. So earlier in the year, it was trading below the moving averages. So these are the 50 and 100-day moving averages. So gold was trading below that. We're now back above the moving averages. So what often happens when we get that flip, when we go from below to above a moving average, quite often after the initial momentum dies down, you get a retest of the averages. So that's in the case of gold, that could see the market pause here and come back, and that probably coincides with that US dollar index, how it looks like it could bounce off the lows. So I think, look, I'm really bullish on gold medium to longer term. The short-term timing of it now, I'd say, people who aren't established in gold, you'd look at this potential pullback as the opportunity to start to establish a position. And then if we can start to see a rebound off the moving averages, if that's what happens, that could then be the catalyst to buy. So I think we're going to see some good stuff in gold maybe over the latter half of the year. But I think the initial excitement of the last few months, well, that could be just
just settling down now. Nothing moves up in a straight line. We've got to have those pauses and consolidations. So I think that's probably the case for gold.
Yeah, I know a lot of the analysts that we've spoken to have made pretty big calls when it comes to that gold price towards the end of the year. We're talking like the 3,000 mark. So definitely one to watch. Jason, always great to have you on The Trade. Thanks so much for joining us today.
Cara, always been fun.
Awesome.